Today's topic, investing mistakes that high-income households make and how to avoid them. That's right. We work with some of the coolest people out there, mostly physicians, which I label some of the coolest people by far, but also a lot of other high-income professionals that are linked to the physician community. So we have pharma, we have tech, we have business owners. We see a little bit of everything. So while I always say physicians are our people, we're very good at dealing with the high income group. One, because we're used to dealing with high income households, but two, a lot of our physicians are married to individuals that are not in medicine. So today we're going to cover one, two, three, and two bonuses. Why two bonuses? Well, as I was making the script for this, I added two more at the last minute. So we're going to cover those too. So as always, get ready. It's coming up next. All right, let's get into the top three with two bonuses. But first, as you know, I like to plug in right around now in every video. If you have not subscribed, please do so now. If you don't feel like doing that, I get it, sure. Give us a thumbs up though. Spread the message. Click on the bell icon, get a notification every time we release a new weekly video. That's it. That's a sales pitch. One other thing I have noted in a few, we are a rapidly growing financial planning firm. So if you are a physician watching this, or you have a physician spouse, jump into our website, wealthkeel.com, schedule a free icebreaker call. Let's see if we're a good fit. All right, that's the extra pitch. We're done now. Okay, number one. Now, I will say, I don't think that this one relates to the physician community nearly as much as a lot of my other topics do. But this is a serious problem we see. And it is over concentration in company stock. Where do we see this most? Well, we actually see this quite a bit with our spouses of our physicians. And like I said at the start of the video, right, we see a lot of tech. We see a lot of pharma. I'm going to use those as my two biggest examples. But what can happen in these industries? Well, a lot of their compensation can be based on equity compensation. So we got RSUs, we got employee stock purchase programs, we got stock options. What can all this lead to? Well, it can lead to over concentration in company stock, right? You might have too much of your company stock compared to your overall net worth. Now, what you might be saying is, Chad, I think my company's going to the freaking moon, man. And that may be the case, and I hope it is. But still, not having all of your personal, family, net worth in one stock. Remember, we've seen crazy things. Let's bring in Enron here. Enron, would you like to comment? Crazy things can happen where it can go to kaput. And what's our concern here is, well, not only do they pay your paycheck, you also had a large portion, a substantial portion of your net worth in one company stock. So over concentration in company stock is a big concern of ours. I even noted off to the side here in the ESOP plans. Now, it's a little bit harder to get too much, ideally having too much, but even for those of you with ESOP plans, your providers will sometimes, certainly later towards like later age, like 60, 65, 70, give you options to pull money out of the ESOP plan, ESOP, not the employer stock purchase program, where you can then diversify it. They might say you can diversify it in your 401k. There's also some tax strategies you can get into there, but usually that requires all of it to come out. So if it's just a little bit, you might be able to diversify that into your 401k plan. This is only a concern if any of these options are taking up a large portion of your net worth. Well, Chad, what's a large portion of your net worth? I'm glad you asked. So here's what we listed. How to avoid it, because remember, the second part of our video titles and how to avoid that. So how can you avoid this? Well, let's say it's likely a good problem to have, right? You have a company that's issuing stock and stock options, and it must be doing pretty darn good, right? It's now a point that it's a large portion of your net worth. So the first thing we do is, what's your percentage? Now, this can vary with every person. As we say, as a financial planner, our goal is to guide you, make sure you don't do anything silly, but at the end of the day, you still get to make the final call. I think common numbers are 5%. 10%. I think the larger, more established your company is, sometimes that can sneak up maybe a 15. If you get into 20, that starts to give me a little bit of my belly starts to start making some weird sounds. But that's the key is setting that max percentage. Having a systematic sell plan, right? When they vest, you're going to sell it immediately, and then you're going to diversify that into your taxable brokerage account. Things of that nature. Have a plan in place. Understand how the taxes work on that, right? That's a whole nother conversation. And then when you're reinvesting the proceeds, ideally you're diversifying them, right? The whole idea of getting out of individual company risk is to then diversify it. So if company A, your company, goes out of business or has some bad times, stock price plummets, we have some issues there. Where if you're in this big S&P 500 per se, well, let's just say it was one company in the S&P 500, right? Ideally, the other 499 are not going bankrupt, right? So that's one of the big ones we see for high income households, especially for those of you, again, tech and pharma are the two that we see the most. I'm sure other financial advisors or other viewers can chime in and say, no, it's very common in this industry as well. But those are the two that we see most often. Next up, chasing performance. What's happening here? Well, it's you see the next headline, you talk to your buddy. I always say one of the worst places for financial advice, hospital cafeterias. I'm still sticking to that. But chasing performance, trying to search the next hot sector based on what you've seen or heard. And while you may be really good at this, I always use the example that Wall Street pays people an ungodly amount of money and they still get it wrong time and time again. And they're very smart. It's not saying that they're dumb, they're extremely smart, but they still miss it. Why? Because it's very hard to nail this time and time again. The best example we always get is like a Warren Buffett. And I usually come back and say, Warren Buffett is not a stock picker, right? Warren Buffett identifies companies that he knows he can get in, fix up, turn over, and then sell it for a large portion. And clearly, we miss Charlie Munger a lot, but Warren and Charlie were, the two best at that. Not them picking stocks inside of their 401k plan. So chasing performance is a big concern. So how can we avoid this? Well, having rules in place. We call this the investment policy statement, IPS. What are your rules, right? How much risk can you have in there? What do you rebalance? When are you allowed to make changes? Having rules in place allow you to follow them. If you have a financial advisor, they likely already have some form of this for you. When we take on new clients, we use a technology that kind of helps us draft this. I also say having a financial advisor is kind of like the middle ground, the sounding board. I can tell you when crazy news hits, crazy things happen, clients will call us, kind of walk them through, take a deep breath. We don't have to make big changes here. We're talking about changing performance, but I say one of the more common mishaps is get me to cash, the world's ending. And then guess what? The world didn't end. And then it's very hard to time when do you get back in? We're recording this, mid to late 2025. That happens quite a bit around elections. If your party doesn't win, you get freaked out. Get me to cash. The world's ending. And then the world doesn't end. So make some rules and do that through your IPS, your investment policy statement. Have a sounding board. If that's your spouse, if that's your financial advisor, if that's your trusted business partner, keep an eye on this. Review these things consistently, but be very careful chasing the next hot topic or something that's been doing really well recently. If you ask us for our advice here, we are big fans of what we call modern portfolio theory. Build a low-cost, diversified portfolio based on that goal. So maybe retirement accounts are a little bit more stock-heavy, ideally, depending on your age, more stock-heavy. But maybe your taxable brokerage account that is accessible has some more lower risk assets, like we plug in like a municipal bond. And if you say, hey, I need this money very soon, hopefully you're nowhere near the stock or bond market and you're all in cash. Ideally a high yield money market, right? At least get some yield there. So do not get caught chasing performance. I think this is also more common in the high income space because you have conversations. You're thinking, well, my buddy does good income. He's a smart guy. That's what he said. That's what she said. Be careful. Stay in your own little sphere. Everyone's an expert until they're not an expert. Number 3, kind of building on what we just put in a few notes in there in the chasing performance, but ignoring tax efficiencies. So 2 things come to mind when I say this one out loud, also based on my notes. So first one is always take advantage of your tax advantage accounts, right? We covered this in last week's video in terms of maxing out your pre-tax account, especially as a high income household. But one area where this really sticks out is always like your taxable account. So whether it's an individual taxable brokerage account or a joint brokerage account with your spouse, significant other. That one in particular, because it is pushing out 1099s every year, that is where you want to be tax efficient. So we love ETFs, right? We love municipal bonds. Now, you still want to have some tax diversification. So even utilizing, maybe it's a taxable bond ETF. Remember, ETF should be a lot more tax efficient than like a mutual fund. Maybe you are very keen on individual stocks, right? Individual stocks that are more growth tilted. Great things to have inside of your taxable account, because ideally they're not pushing out a lot of things that are creating a tax drag on that 1099. And while it's hard to make it a perfect zero, right? You get a 1099 with nothing on it, especially when you get into ETFs, mutual funds. If we add in some bonds in here, even if they're municipal bonds, you're still going to have those trigger, but you're trying to keep them as low as possible. So keep an eye on tax efficiency. If you have certain asset classes that are not as tax efficient, right? Let's just say that you love high yield bonds. Well, high yield bonds likely would do much better in like a tax qualified account, right? We don't care how much it's spitting out in there, right? Because it's all tax ordinary income. We don't love it inside your taxable account because you're getting a 1099 every single year. So when we talk about asset location, that's what we're referring to. And I would say we love asset location, but we also try to keep an eye on the individual's plan. So that's where I always come back to like that taxable account. It's not uncommon for us to actually have a decent amount of bonds in a taxable account for our clients, especially again, younger accumulator years, because the account's accessible. Why I'd love to just put that all in, growth stocks and to the moon with no 1099, we know that's not reasonable for everybody. And that's where we're just trying to build more tax efficient portfolios. Maybe we have some SMAs that are very tax efficient in what they do, but municipal bonds are a very good example of, hey, having some lower risk assets in a taxable account, but they're still tax efficient. So those were the three main ones. But then I added two bonus, and here's the two bonus for you. I'm going to start with not understanding fees first. I just sent this note to a client that one of the best ways to increase your performance is to have lower fees, right? Because it's just, if you were paying 95 basis points and then you get it down to 25 basis points, but everything else is relatively the same, right? Let's just say you went from a high cost mutual fund that was pretty much tracking the S&P 500 to the S&P 500 ETF. And it's probably even lower than 25 basis points. But those 50 basis points from 0.75 to 0.25, that's 50 basis points. That's 0.5% of performance you added. Again, we assume all things are equal. So not understanding fees is important. But let's go a little bit more deeper than that. So that level of fees is what we call expense ratios. The actual internal fee of an investment of that mutual fund, of that ETF, you don't have to worry about this on individual stocks. That's called the expense ratio. That's just one layer, right? There's also two other layers you need to be aware of, right? The likely the biggest one is, does your advisor, if you're working with a financial advisor, do they have an advisory fee? Are they charging you an AUM fee? I think the most quoted one is 1%. Ideally, with more assets, that continues to come down, whether that's a tiered or a cliff schedule. But what are your advisory fees? And then what we've continued to see, and this is actually what we utilize, you'll see a lot of advisors these days utilizing investment platforms. We label them as TAMPs a lot of times, third-party asset managers. What are their fees, right? Or even like the Vanguard personal PAS, personal advisor service. They charge 30 basis points. Those are platform fees. So if your advisor is using these types of models, and again, that's what we utilize. We believe there's a huge efficiency in that process now. What are those fees? And then you still have expense ratios. So if you're using certain advisors, right, you could have three layers of fees. What's the advisory fee? What's the platform fee? What's the expense ratios? Make sure you understand all the fees. That is one. I wouldn't call it. No, I actually would label it as an investing mistake. You're understanding all the fees while you're investing. And the last one I added here, because I feel like this is, whenever you have a hot asset class for a long time, you get something called recency bias. And the two that come to mind is tech has been on fire. US large cap has been like the top performing asset class, I think like 8 of the last 10 years. So you start to think, you're sitting there like, well, why don't I have everything in US large cap and tech? Yes, hindsight is always 2020, but we know that the future does not always work that way, which is why, again, we always do like the idea of a diversified low-cost portfolio built around your goals. Again, retirement bucket, maybe middle of the road bucket, and then short-term bucket. But don't get caught up in recency bias. So far this year, international has performed much better. We continue to say at some point, international does have to outperform US. At least we think so. Will it happen? Who knows? But US has performed really well. But just be careful with recency bias. And remember, if you come back to over concentration in company stock and you're someone sitting there in tech, but then most of your portfolios are also heavy in tech. Again, if tech's doing well, you're like, man, this is easy, money in the bank. But remember, tides will change, things will change. So just keep an eye on that. So those are the most common I almost said calming. We can make this calming. Common investment mistakes we see for high income households and how to avoid them. Again, the three are over concentration in company stock, chasing performance, ignoring tax efficiency, bonuses included not understanding your fees, and then recency bias. So those are the 5 that we got. Questions, comments, concerns, drop those below. If you have other topics of videos or things that we can add on to this video, drop those in the comments below. If you'd like to send us a more personal note, you can click on the link we have in the show notes. And that's what we got for today. As always, thanks for hanging out with me for the last 15 minutes or so, right on our sweet spot. And I will catch you on the next